bounce to the upside, looking to move above $87 on Brent. Let's kick off with our regular commentator, and Happy New Year to everybody, because these are our first time having you guys all on since the new year, since our 1 month sabbatical. So welcome back. Let's kick off with Randall Mohammed, Managing Director of Petro Industrial USA, sitting in Miami. Randall, interesting comments overnight. There seems to be some sort of disagreement by the oil majors in the US as to how quickly US production is going to recover. There's a growing narrative in the market that the first half of the year will be tight, and the second half will ease up because US production will come back. How do you see things this beginning of the year?
Hi, good morning, Sean. Yes, Happy New Year to you, and Happy New Year to everyone. Yeah, look, we expected shale to come back a lot quicker, but the US is still the leader, 10.5 million barrels per day. Based on the forecast from the oil producers, looks as though we're going to get up to 12.5 million barrels by sometime 2023. I think that's the forecast coming from the producers. Having said that, shale production in the Permian in particular has certainly taken off. There was record production in December, and we expect that trend to continue. Now, as you know, Sean, not all basins were created equal. So what we're going to find is that the more economical basins are going to start producing, firstly, and then as the price begins to inch closer to $100, you're going to find production coming from the other basins, like in North Dakota, Pennsylvania, for example, where the cost of production is a little higher than the Permian. So that's the prediction.
We've seen the Oxy CEO has been very bearish on the recovery of U.S. production for some time, even though she was made that big bet in making probably the biggest acquisition during the pandemic period. But ConocoPhillips much more optimistic. What's the difference in their perspective on the recovery of U.S. production?
Well, that's a good question, Sean. I don't know exactly where the difference is and how they see things. But
there has been a lot of consideration that banking finance wouldn't return to support the recovery in shale. Is that narrative justified?
That could be part of the narrative. Yes. We did see capital sort of pull back. In the last couple of years, but I think as prices begin to escalate, I think you're going to see that capital come back, and the capital is coming back slowly but surely. But I don't think production is going to get back to where it was, Sean. The US got up to 13.5 million barrels per day. It's highly unlikely we're going to get back to that level of production, but certainly by 2023, there's going to be an extra million and a half barrels, coming out of the US.
Let's go to Henning Gloystein, Director, Energy, Climate and Resources at the Eurasia Group. Henning, good morning. Happy New Year. Looking at the Eurasia Group's top 10 risks for 2022, the top risks report that you guys publish at the beginning of the year. Notable from my perspective, at least, that you only have Russia and the whole Ukraine crisis at number 5, but the China net zero COVID at number 1. What is the thinking there?
Good morning, Sean. Indeed, we've been asked that a lot in the last couple of weeks. So the thinking there is actually that Russia and Ukraine still will not grow into a full-blown war, but remain a simmering crisis.
You'll be partly pregnant, but not fully pregnant. I mean, what does that mean exactly? Are you being Biden-esque in what that sentiment is? Well, a little bit of in isn't the whole in. I mean, what does that mean exactly?
It means that Putin is trying to test just how far he can get. What can he take from the West, especially how strong or weak actually is the European response. So if he can get away with occupying, maybe annexing part of eastern Ukraine, where ethnic Russians dominate, then he will, but he will probably shy away from a full-blown war. That said, the risk of full-blown war since the start of the year, since we put out that list on Jan 4, has increased. The China aspect is largely an economic aspect, that because Omicron is so contagious that the net zero drastic measures that China has to take in order to keep the net zero policy upward and successful will mean such draconic lockdowns that it'll shoot its own economy into the foot.
I'm just wondering on that point. I mean, clearly the zero COVID policy has been in place for some time now, and yet the global economic recovery, certainly in the OECD, looks pretty robust. Oil demand is, pretty much soaring back to pre-COVID levels, et cetera, et cetera. It's hard to identify the real consequences of this China COVID zero policy, at least the contagion of it. Slower Chinese growth, yes, but the contagion consequences of that, not yet really that obvious on the global stage. What are your thoughts?
Yeah, it's indeed. They're not obvious yet, and we don't really know yet. You're absolutely right. The economy in the US, in Europe, in most other developed nations have actually fared fairly well, even amid Omicron. And if China manages to bumble through Omicron, and then for sure, then we might get out of this better than we thought or feared we would. But if China's growth really stalls, there's of course the real estate crisis in China as well, then that could become a serious problem. And that is why it was one of our top risks, or the top risks. But that could prove to be a scare rather than a serious problem for the world. We'll have to wait and see, I'm afraid.
Yeah, well, I think, as you said, a lot changes in a few weeks. Dr. Charles Elinas, CEO of Cyprus Natural Hydrocarbons Company and a senior fellow at the Global Energy Center at the Atlantic Council. The Atlantic Council is going to be earning their wages at the moment, I would think, Dr. Charles, trying to make sense of all of this cross-Atlantic drama. Looking specifically at Europe, Dr. Charles, does Europe have alternative energy supply opportunities, sort of contingencies to a possible Russia shutdown on both oil and gas? If you listen to the politicians, these sanctions are going to be scary. They're going to be bigger, better, faster than the last 5,000 sanctions. What happens to Europe if they lose access to Russian energy?
Good morning, Sean. Good morning, everybody, and Happy New Year. Well, Europe doesn't have many alternatives. I mean, the amount of gas, for example, imported by Europe, it's huge. It cannot just be replaced from one day to the next by something else. But unless there is a full-blown war between the US and the Russians on Ukraine, or between Russia and Ukraine, the impact on gas imports to Europe of this conflict is small, because the amount of gas coming through Ukraine to Europe now is actually very, very small. It's only about a quarter of what it used to be. So the impact is not going to be felt. It's just magnified by the situation, not by reality.
Does Europe have the ability? Does it have the kind of strength, if you like, in which to put energy sanctions on the table if indeed this does cross whatever red line is identified?
I doubt it. I think if you noticed during the last few days, Europe is sitting on the fence. I mean, the Americans and the Brits pulled their diplomatic staff out of Kiev. Europe is doing nothing of the sort. It's staying put. And the reason, I believe, is because Europe is, first of all, doesn't believe that this is going to be turned to a full-blown conflict. And the second is that it really, especially Germany, really depends on Russia for gas. So they don't want to overreact too far, too soon, and cause problems unnecessarily. And I believe that is going to prevail in the end. I don't personally, I don't expect this conflict to escalate much beyond Putin getting some response from the United States, some concessions to make him happy and backing off. So as a result of
I know a lot of people are saying that. I'm struggling to identify what they're putting that sort of thought into, and we've had our commentators continuously advocate that Putin isn't really, but I don't see the evidence that supports that thesis other than it would be a serious own goal. But what evidence do you see that indicates that Putin isn't willing to sort of follow through with knocking on the door of the Ukrainian president's palace and kicking him out?
It's the consequences to Russia. I mean, the consequences to Russia will be devastating if he does anything serious. There may be some small. I don't see a small. What does small mean? If he goes into Ukraine, it's big. Whichever way you look at it, it's going to have.
He's already in Ukraine, right? He's taken Crimea. He pretty much owns the eastern provinces. It's hard, you've got an appeasement government, clearly Biden, Obama, red line in Syria, withdrawal from Afghanistan, give up Crimea. If you're Putin, you're thinking this is a free pass. I would think Germany's essentially telling him, yeah, go ahead, no problem.
Even Biden, in a way, told him, go ahead. Provided you don't do anything major, it's okay. No, I still don't think that Putin has anything much more to gain. He has Crimea. He's not going to give it up. Donetsk is controlled by him. He's not going to give it up. Why should he go and escalate the whole thing a little bit more when he's getting what he wants? I mean, NATO is not bringing Ukraine into its fold. Despite all these problems, NATO is not going into Ukraine. It's staying out of Ukraine. And so, in effect, Putin is already getting what he wants. Why would he want to go and escalate it and attract not just sanctions, huge penalties? I don't see that happening.
Randall, does America care about Ukraine? Do the Americans even know where Ukraine is? Could Biden give it up and not suffer any consequences?
Well, I should think most Americans should know where Ukraine is. Most may
should
not.
Is a very big word.
But no, I think...
you know what I mean? They don't typically care about foreign policy issues like this. Has this escalated into another space where, no, this is something Americans do care about?
Well, I think, Sean, until it hits them in their back pocket, then they're going to think about it. I think right now, Sean, we're grappling with inflation. We've got this serious inflation problem. Look, the Fed is under serious pressure. Biden is under serious pressure. They treat with it. I think Powell has given up the narrative transitory inflation. I think he's retired that term. I think he's recognized now that, guys, this is much bigger than what we thought. And even though they've got tools to deal with the inflation, these are conventional tools. Open market operations and interest rates. The other side of the equation, Sean, is the supply chain problems. And that's not easily resolved by Biden nor Powell. So I think there's a lot of domestic issues that he has to grapple with. If we throw Ukraine and Russia on top of that, that's just simply a pot waiting to explode.
That's drowning when you've got the Iran talks as well. But Randall, you do have the opportunity for US LNG to be a winner in this equation. Perhaps we're already seeing a big increase in exports to Europe. Where do you see LNG? The question I asked Charles earlier, can the US LNG be a savior, be some kind of a contingency for a European energy demand?
Well, I don't think it'll be a contingency. I don't think there's enough LNG coming out of the US to satisfy European demand. If you remember correctly, back when Trump was in power, he did extend the permit to export LNG to 2050. And at that time, it was touted as Freedom Gas. And Freedom Gas was really aimed at Russia, wasn't it? There was a concern that once that Nord Stream 2 pipeline was completed, Russia would basically monopolize gas into Europe, which they saw as a big risk. And it's a risk that may come to light. But definitely, if I were the Europeans, I would be dusting off my contingency plans in case this
I would have done that a
breaks
while ago. Henning, on that point, the idea that is this a kind of an OPEC 1974 moment for Europe in a way that created the IEA in the first place? You know, Europe waking up, realizing, oh my God, we're so dependent on Russia here. We've no cards to play. This is a sort of, you know, check-in moment where we've got to change the paradigm and get, you know, locked into US LNG, maybe not for this crisis this winter, but for all the winters ahead. How do you see this as a structural game changer, regardless of whether Putin goes to Kiev or not?
Okay, I think that's actually a key question. And there's definitely been a change of thinking in some of the key administrations in Europe, Germany, Italy, most notably. Some of the staunchest supporters of ongoing pipeline diplomacy with Russia. So, you know, despite all political problems, keep the business going. That's how it was invented 40 years ago, are on the back foot and having to rethink Nord Stream 2. Do we really do this? Or should Germany try and accelerate and, you know, really go through with Brunsbüttel LNG, the first LNG import terminal in Germany, which we think is going to happen. Italy will probably sign more, try and find more LNG contracts away. We haven't mentioned Qatar here yet, 30% expansion going on. They've still got to sell some contracts there, and I suspect they will. So, yeah, I think there is a change and dusting off old contracts in the US and having a chat with them to see whether some extra LNG cargoes between now and 2030 could help reduce reliance on Russian gas. And then lastly, this is going to accelerate the green transition in Europe. A risk of disruption of fossil fuel imports, high fossil fuel prices, high carbon permit prices sends the signal to invest locally. The problem is that won't be that won't solve any problems this winter or next. That's a long-term thing, whereas more LNG could actually be achieved quite fast. More LNG tankers from the US and Qatar have arrived in Europe over the last couple of weeks, and the spot LNG price has halved over the last 4 weeks because of exactly that. So clearly people over Christmas in Europe were worrying a little bit and calling up some shippers to get some LNG.
I suppose a lot of talk, Charles, about Russia and Ukraine, and thinks of obviously gas being the big energy source. But of course, 1.5 million barrels of oil comes from Russia, the Urals, into most of the Eastern European refineries at the moment, a heavy dependency there. Generally, Charles, the oil markets are quite tight at the moment, regardless of Ukraine. We're moving upward in price because of tightness. We had the Saudi oil minister overnight saying that he expects to get beyond pre-COVID levels of 100 million barrels by the end of 22.
And that's exactly why, going back to what I said before, I see Putin knows all of these things, and he's posturing to get some concessions, and he's gradually getting the concessions. As a result, I don't see this conflict going beyond skirmishing. And beyond that, I see Nord Stream 2 coming into fruition by the summer, being approved, and easing the gas crisis in Europe. Europe cannot deal with the gas crisis by LNG imports alone. It's a huge problem. And an indication of this is that because of the energy crisis that has been caused partly by too much reliance on renewables and shutting down coal plants and nuclear plants too fast, Europe is now introducing gas and nuclear power back into its taxonomy to be able to deal with this crisis. So Europe is admitting that gas is part of the equation for the future.
Gas is now a green transition fuel.
Exactly. As a result of that, with Europe admitting that gas has to be part of the energy equation of the future, it cannot just replace it from one day to the next, and it cannot do away with Russian gas. And I think in the end, I see behind the scenes a lot of diplomacy to diffuse the situation by some tacit concessions that satisfy Putin that his whatever perceives to be his security perceptions are satisfied and backing off. I cannot see this going beyond that, because if it does, not only causes Russia.
But I think ultimately, Charles, if you look beyond the immediate, the sort of immediate chessboard and look, I think, slightly bigger time, bigger picture. Ukraine is on a slide west. There's no doubt about it. The people want to go west. They want to, as they used to say in the old Soviet days, wear denim jeans and drink, eat McDonald's, all the usual sort of cliches. But Ukraine is moving west, and perhaps from a Russian point of view, if they don't act now, it's lost, regardless of this machinations. But I don't want to get too swallowed up there, Randall, because at the end of the day, this is a tight oil market. Geopolitics has its role to play in lifting price, but supply and demand really getting tight. The first half of the year in particular, your thoughts on the narrative that the second half will ease up because we're going to get sort of new supply coming in from the likes of Guyana and elsewhere?
No, undoubtedly, Sean. Look, it's still, prices are still being predominantly driven by those supply-demand fundamentals. Yes, geopolitics will play a role in it, but I think it's more of a minor role. We've seen in the past where geopolitics will cause price to increase, but that price will sort of, come back down as the market absorbs it. But by and large, it is a supply-demand issue, and we are in a tight supply situation. Yes, there's oil in Guyana, but there's not enough oil that will come on stream to satisfy the demand. Guyana is pumping around 120,000 barrels per day. The projection for Guyana is 750,000 barrels by 2030, and it could be upwards of 1 million barrels thereafter. So yes, Guyana is there, but I think Iran needs to play a role in this whole scenario, and I think there's also room for Venezuela if and when those sanctions are removed in Venezuela. Now, Venezuela sits on 300 billion barrels of oil, but the problem is there's not a single drilling rig operating in Venezuela. Their production has collapsed. From the highs of 2.53 million barrels per day, all the way down to 400,000 barrels per day. So these are the things that we have to look at. The Stone Age didn't end for lack of stones, did it? There's lots of
still
oil
a few
out
in
there.
my back garden. Let's go to the survey question and see what the room's view is on this point. That do you subscribe to the theory that H1 oil market tightness will ease in H2? I mean, we have Citibank claiming that second half of the year slide sees oil prices ending the year in the 60s. Of course, Goldman Sachs sees it above 100. But do you subscribe to the theory that H1 tightness will ease in H2 with new supply and perhaps even Iran, maybe others coming back to ease the tightness? But we have a situation at the moment where we don't, OPEC Plus is not even able to meet its 400,000 barrels a day at the moment. Henning, your thoughts on that question, tightness into the second half, and within that, the point you started out with, China demand. We saw last year, the first year, a decrease in imports.
Yeah, I think one of the biggest worries in oil markets at the moment is, and Randall just mentioned it a little bit, there's been a lack of investment in drilling, not just in Venezuela, in quite a lot of countries, which means that even if demand picks up to pre-pandemic levels this year, which is very possible, it could even be earlier than the end of the year, then that supply side just can't keep up. Whereas the people who could be drilling, they see a higher oil price and think this is wonderful as demand bounces back. So that is the bullish scenario. Then you've got geopolitics, Iran, Venezuela, Russia, happening, and that's the tightness. Whereas there's the downside risk, of course, is that the problems with Omicron and inflation and China real estate continue, and then we could see that slide, and that's the Citibank scenario.
We had a commentator on our UAE Energy Forum last or 2 weeks ago, Xavier Chen, who is the former head of BP in China. He's calling peak oil demand in China. Your thoughts on that as a concept?
It'll happen. I don't think it'll happen this year, but I think it'll happen pre-2025, give or take.
Wow.
That's when the EV market, they all say they're going to pick up. The steel industry, which because there's a lot of diesel and construction industry is going to shift. But I mean, identifying when that happens is an I don't know, it's an art.
Well, it's certainly something that OPEC has put a lot of dependency on in that regard. Charles, the East Med, any solutions coming out there at these prices? You guys must be out, with hammers and chisels in your own back gardens.
No solutions. So the reason is because this is a long-term project. I mean, it will take 5 years to make it happen, and then operations for another 20 years to get the money back. So
does the Erdogan's kind of diplomatic efforts in the region ease the opportunity, open the door, remove that hurdle as such?
No, it doesn't. Erdogan is still threatening things in the East Med against Cyprus and against Greece. That is not going to change. And his offer to take the gas from Israel through Turkey to Europe is equally problematic. These projects go nowhere. The future, in my view, the future of long gas pipelines is over, apart from perhaps a pipeline from Russia to China. There will not be any more long gas pipelines anywhere in the world, including the East Med. But can I come back to one point we missed? One point we haven't talked about is the fact that Omicron is proving to be short-lived. It's waning. It's going away fast. Here in Europe, the United Kingdom has already removed more or less all restrictions. Here, where I am now in The Hague, the government is following the same route. And I see this happening faster and faster, and the effect of Omicron will be quite short-lived. That will boost demand faster than many people expected, simply because Omicron will not be there. And another factor I haven't talked about is that China itself is easing its monetary policy. It's reducing rates, and that is also going to have an effect in, at least for the short term, increasing oil demand in China. So between these two things, I see oil demand increasing, and the problem you mentioned about tightness of supply causing a problem for a while.
Let's give Randall the last word today. A lot happening in America at the moment. So we'll welcome you. Let's get the survey answer first and see what the view in the room here is. Do you subscribe to the theory H1 oil market tightness, H2 eases? A little bit of a majority on that, but nothing overwhelming. Randall, big week. Obviously, the first Fed meeting tomorrow of the year. I think it's tomorrow or Thursday. Clearly, we had stats yesterday. Omicron, the average highest since 11 months in the US from death rate and infection rate and so on. I'm wondering, is that still a big issue there? In Europe, there's still high infection rates, but essentially, as Dr. Charles said, they're moving into a post-COVID posture.
Well, yeah, I agree, Sean. I think we are moving into a post-COVID posture. Now, mind you, the full vaccination in the rate is still around that sort of 61-62% rate. Nothing to really write home about. We're still a long way off from herd immunity. We still, until we get to that 70-75%, then yes, I can say we've rounded the corner. But look, the Fed is really challenged. You've got a situation where they can control liquidity somewhat. They can ease off the pedal on that asset buying, and they can do stuff with interest rates. But the other side of the coin, as I mentioned, which was the supply side problems, that is a problem that we're going to have to grapple with in the next, probably in the next 2 or 3 quarters. So I don't see any ease on that. Look, just yesterday I was in the supermarket, and look, there are signs of empty shelves. Not in all items, but in certain items. So it tells me that there are still problems with the supply side of it, and that's.
Is there any? I mean, we've seen over the last 6 months, 3 months, a real compressing acceleration by all Fed commentary and signals, right? The tapering reduced from 6 months to 3 months. Now the interest rates from 0 to 4. Goldman Sachs even indicating it might need to be more. Do you expect this sort of compressed acceleration to continue? And would that potentially include a surprise this week with a possible rate hike coming sooner than March being the expected first one?
Well, Sean, I would still tell the Fed to be cautious. I don't think we've really gotten out of this sort of, I think we're still in this recovery effort. And I think if the Fed moves too quickly, we're going to stall the economy. So what I think should happen is that the Fed should do the tapering, but do it over sort of 8 to 10 month period. Keep their eyes on those leading indicators. The unemployment claims is one, and of course, inflation is the other thing. So I think, we need time. We need to take it slow. Yes, interest rate hikes will come, and they're going to begin with what we call the Fed fund rate. So the Fed fund rate will be the first thing to increase, and then that makes its way up into what we call the prime rate.
You wonder if that's all sounds very nice and measured, but have we run out of time? We have on this podcast, time is over, but it's certainly worth noting that this issue of disruption, of volatility, I think filtered right through our 30-minute conversation. We saw it yesterday in the equity markets. The S&P 500 started the day down 4% and ended up above par. So that's a volatile day in anybody's book. I think you'll see more of it with all of these issues, from no invasion of Ukraine to kicking the door down to the president's palace to no rate hikes to maybe 5 this year. So this is clearly volatile times. Strap up and bet well. Thank you, Randall. Thank you, Henning. Thank you, Dr. Charles. Lovely to have you back. Happy New Year. We're here every morning, 10:30 UAE time. All the best.